Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Today, we have a special guest on SBTV, Luke Gromen, who is the founder of Forest for the Trees, or FFTT LLC, an investment research firm that aggregates a variety of publicly available data points in an unconventional manner to identify developing investment trends. He is also the author of the Mr. X Interviews, Worldviews from a Fictional U.S. Sovereign Creditor, a fascinating read which we will discuss in our conversation with him. And we're delighted to have him here today as our guest. Good day, Luke, and welcome to SBTV. How are you doing?
I'm doing great. How are you doing today? Thanks for having me on.
I'm doing fine. Thank you. Thank you. We're glad that you could make it. Luke, I read your interview in the 2018 In Gold We Trust report, and I knew I had to get you on the show. Can't wait to get into the questions I have for you today, which I believe will greatly benefit all of us with your insights. But first, tell us about the book that you wrote and what got you to write it.
The Mr. X book? Yeah.
Yes.
So it was the genesis of Mr. X was one of my best relationships on Wall Street. He's a veteran macro trader, and we've interacted for a long time. And about 3 years ago, we were talking about something, and he said, you should write almost like an interview of a fictional creditor just to sort of illuminate some of these thought processes. And it was very interesting because I was at that moment thinking about a format that would allow me to really talk through some of these formats or some of these issues, because when in our reports, they're very fact-based. It's this happened, here's this story, here's this official, here's this event, and we put these things together and we in a unique manner, and we try to identify a potential range of outcomes. And so, but what that doesn't allow for is speculation, informed speculation, and so and giving some personality, some color to it. And so it was, after he suggested it, I sat down and wrote the first sort of installment to what became the Mr. X book, in a report in probably 3 hours, and it was probably 20 pages, bang, and it really was it was a fun format. It was a freeing format because it allows you to sort of put together things maybe you otherwise wouldn't. It allows to, and I think it's a very informative way of doing things for customers. And ultimately, when it became the book, sort of a compilation of these Mr. X interviews, I think it's an informative way of just helping people, be able to read through, what a potential thought process to some of the events we're all watching unfold might be.
Yeah, it seems like a fun book from the first chapter. So you're able to read it free from Amazon. So I went and took a look at it, and it seems like a very fun, intriguing, informative book. So I'm going to have to get me a copy. But with your company, Forest, yeah, it's a great book. Your firm, Forest for the Trees. Can you share with us what inspired you to give it that name?
Yeah, what inspired me to give that name was in the aftermath of 2008, into 2008, and the aftermath of it. In the seat I was in prior, I was just seeing a trend on Wall Street, in American society, globally, where there was an increasing siloization, if you will, and people working in smaller and smaller silos, and no one ever interacting between the silos, and there was very little interaction between these silos, and there was very few people trying to take a step back and put the broader picture together to see the forest for the trees. And so it seemed to me to possibly be a very useful and interesting niche, and it happened to be something that I had a natural knack for, and have always had a natural knack for. And so, I thought it was one of these, names that abbreviates well, and it describes what we try to do in every edition of FFTT.
Okay. Getting back to your book, the Mr. X Interviews, uh, got to read part of the first chapter, as I said, it was on Amazon. Already very, very fascinating. Mr. X, a fictional U.S. sovereign creditor. believes a dollar crisis is going to happen. What would you say is the main cause for this coming dollar crisis?
I think it's the combination of U.S. unconstrained U.S. fiscal spending, demographics, and a unwillingness by foreign sovereign creditors to basically underwrite U.S. deficits any longer, like they had for a long period of time. And there's a number of different reasons they are unwilling or unable to do so anymore. But it's really the confluence of those factors driving that.
Okay, so I would say that's probably one of the clues that the dollar crisis is coming. Any other clues that we can see that's already on the table?
Yeah, I think it's the biggest clue I would say is the fact that in the third quarter of 2014, global central banks, excuse me, stopped growing their holdings of Treasury bonds, and they have not increased their holdings of Treasury bonds ever since. Global central banks since 2013, in fact, have been they bought about $140 billion worth of gold, and they've net sold about $130 billion worth of Treasury bonds. And so, ironically, one of the first signs that you would see, and one of the biggest signs you would see, that this fiscal crisis around the dollar-centric system is building, is you would expect to see the dollar rise sharply against other currencies, which is very counterintuitive. You'd start to see interest rates rise, and you've seen LIBOR bottomed in the third quarter of 14. The dollar bottomed or really started taking off in the third quarter of 14. And those are really the big ones in terms of financial metrics. And then geopolitically, if this was happening, you would expect to see the U.S. picking fights with lots of people that you're somewhat surprised to see them pick fights with, and weaponize the dollar in certain ways. And so some of this of what we're watching is purely, mechanically, financially driven when you talk about the dollar and LIBOR and rates. But some of this is a little bit more intuitive and sort of soft indicators, if you will, in terms of some of the geopolitical indicators. And that gets back to the forest for the trees point. But those are the things that you'd expect to start seeing.
The dollar crisis, how soon can we expect it to really start to happen to where we notice it?
I think things are coming to a head much more rapidly than most people realize when you look at the actual math of it, right? And so there was Ray Dalio gave a great interview to Bloomberg last fall in September. And he said, look, we've got about 24 months until the Fed is going to need to basically fill in the gap, because basically what you're looking at, it's mechanically, it's very clear. Okay, so if global central banks aren't growing their stockpiles of treasuries anymore, somebody else has to buy them.
Yeah.
And as somebody else has to buy them is the global private sector. And unlike central banks, the private sector has a finite balance sheet. They mark other than U.S. banks, they mark their holdings to market. So they're actually at risk, and they have a finite balance sheet. And so as U.S. deficits grow, as they grow and grow and grow and grow in terms of our debt, this begins to force interest rates higher. This begins to crowd out the rest of the world, which drives the dollar higher, ironically. So you can see these dynamics happening. Then the question gets into, when does this become a problem? And it forces one of three things. Either the U.S. has to slash government spending, and as a practical matter, over 100% of tax revenues are spent on three things. It's entitlements, it's defense, and it's interest expense. So you've got to cut one of those three. Mm-hmm. Politically, none of those three you can really cut in any real way. Interest expense you can cut, but again, that ties back to that's going to weaken the dollar if you start cutting rates at this point. The other thing you can do is you can go to war to defend this, or you can sanction people. And obviously, we're trying some of the sanction side, but this too is sort of a penny wise, pound foolish. It buys you time, but it ultimately speeds up the end game or brings it forward. Or you can have the Fed monetize the difference effectively, right? Start growing their balance sheet again. And so it's been interesting to me as I'm looking for signs of where we are in terms of signposts. All of a sudden, the way MMT is getting some mainstream discussion the way it is in terms of the way it has. When you lay these things out, I think this is, and Dalio talks about this. The private sector can only fund so much, and within 24 months, it's not going to have the balance sheet capacity to do what we need to do. And that 24 months is not a fixed period of time. That's sort of assuming there's a lot of different inputs. It assumes a fairly steady state because we run our own models, and we had run our own model right before Dalio gave that interview. And our models had said, yeah, we're probably, in a steady state about 24 months away from the Fed having to basically monetize the difference, basically start regrowing their balance sheet again. And that was best case. That was assuming there were no slowdowns anywhere in the world. And you're seeing not just slowdowns, you're seeing significant, slowdowns now in important leading indicators like South Korean exports, like German industrial production. These are your leading indicators of the world. So that 24 months is like I said, a fluid indicator. If the economy softens, that 24 months might be 18 months, or it might be 14 months. And then you start talking about that. That was from September of 2018. So if the real number is 14 months or 18 months, now you're talking about early 2020, in terms of when this could be a problem. And markets, of course, are forward-looking. And so, it's a fluid number. There are a lot of inputs, but the bottom line to it, to me, is the dynamics are pretty clear. Things can change. If central banks came out tomorrow and said, all right, we're going to start buying, treasury bonds, again, to basically sterilize U.S. deficits, that's a huge change. That would require a change in view. But as things stand now, the consensus view is that we're 5, 8, 10 years away from this mattering. And our point, and we say to our customers all the time, like this is all going to be over but the crying in probably 2 years or less.
Wow, that's pretty soon. But with what you're saying, is the U.S. dollar still the center of the world today, or do we just think it is?
I think it's still the center of the world today, but I think it's rapidly changing. And I don't think anything is going to replace the dollar. And I don't think, as we go on in the Mr. X book to note, it's important to note China doesn't want to replace the dollar. The Europeans don't want to replace the dollar as it's structured. What they want is a neutral reserve asset to replace treasury bonds as the world's premier reserve asset. And I think that's the direction everybody's moving. That then implies a number of different things.
Yeah. Well, what do you think that neutral asset would be?
When right now, if you watch what they're doing, it's gold. As we noted before, central banks since 2013 have bought 140 billion in gold. They've sold 130 billion on netted treasury bonds. And what to me, that's probably a placeholder of sorts, right? Because in theory, it just needs to be a neutral reserve asset. It can be SDRs, it can be SDRs with gold, it can be SDRs with a commodity basket. There's a number of different ways mechanically you can do this, but all of these things require everybody getting in a room and agreeing to something. And I thought Jim Rickards had a great point that it's when he wrote, I forget which book it was in, but it was a stretch that they were all going to get in a room and agree on anything 3 years ago. And you look around the world today, the odds of them all getting in a room and agreeing on anything, it's not going to happen. And so to me, when, whether it's nobody can agree or whether it truly is a chaotic outcome, which, unfortunately, the odds of that are while still a tail risk, are rising. Then you go to what has always worked, which is gold, and as a neutral settlement asset, and I think that to me is where central banks seem to be moving.
Yeah, I think the dollar seemed to be okay when it was gold back, and then it became the petrodollar. And today, how do you think the Saudis view this petrodollar?
I think the Saudis are very conflicted about it. And what I mean by that is they have longstanding relationships, longstanding geopolitical ties. the deal has worked very well for them relative to security, relative to stability, et cetera, et cetera. That's the one side, but I think why they're conflicted is they're looking around the world, and the Americans are one of their biggest competitors. And the reality is that their biggest customer is now China. And China's making noise. They want to buy oil in yuan, and China's moving market share. China has taken Saudi from their #1 supplier to their #2 or #3 supplier, behind the Russians, behind the Angolans, and have said in Chinese media repeatedly, those that sell to us in yuan will get our business, and those that don't will get dropped down. Now, Saudi's a big player, so they have some leverage, but ultimately, I think that the Saudis are in a very tough spot in terms of understanding, if it was a purely free market, the decision would be easy and obvious. They'd already be selling in yuan. But the geopolitical angle, and let's face it, the risks to their own security and stability, some of the geopolitical side, makes this a slower decision. But I think ultimately that's the direction that they're going to go. And you've seen some, public, the Saudi finance minister 3 weeks ago said we're looking at issuing debt in euros and eventually in yuan as well. And that's basically a statement we're not pricing oil in currencies other than the dollar. And so I think they see the writing on the wall, and this ultimately funnels into this, neutral settlement asset, right? In terms of you've got to have that set before you can make those moves.
Yeah. Do you think Saudi was looking for another currency to accept payments for oil, or do you think maybe they're being forced somewhat by China's statements?
I think this is more China. I think this is the buy side, if you will, selling this or driving this process of China, and I think China supported by Russia, right? China can do whatever it wants to do, but if every oil exporter sort of stays, in a cartel, even with the Russians not technically in OPEC, but if they all stay together and agree to only sell in dollars, then China's locked out. But I think the combination of China plus Russia, Iran, and Venezuela doing what they're doing, where they're not playing ball, that is, if just one of those oil exporters sided with the Chinese, that would be more than enough. All three of them is plenty to really destabilize the system as it stands in terms of shifting it from a dollar-only market to a multi-currency energy pricing system.
Why do you think the attitudes of the Saudis towards the U.S. dollar changed in such a manner? Do they feel perhaps oppressed or controlled by the U.S.?
I think the key thing that really changed it was really the economic realities of the world. Their biggest customer is China, and when you look at all forecast of prospective energy and oil demand over the next 5 years, 10 years, 20 years, China's economy is slowing. Yes, China may have a crisis in that time frame, but it doesn't change the fact when you look at the per capita oil consumption in China relative to the per capita oil consumption in the developed world, where their bread is going to be buttered over the next 5, 10, 15 years. And, because, it's important that, you've got these other oil exporters willing to cater to China, that the Saudis, I think the Saudis are basically being forced into it. And they're in this very delicate position of trying to keep the Chinese happy and keep that business while also not angering the Americans. And that's a very delicate position they're in. And I think they're trying to sort of, dance do that delicate dance, I guess, if you will.
Yeah. Have they angered the Americans? Considering Trump has gotten the U.S. to be, I think, the largest oil exporter right now.
I think some Americans. I think there's, as this situation continues to develop, it's becoming more and more clear to me there's at least two Americas, and maybe three. I don't know, but it's, there are elements of the national security establishment that I think it angers very greatly. they're, whether they're neocons or, neoliberal, however you want to define them, they're sort of this, old guard,
Yeah.
if you will. And then I think there's another side where and they're not necessarily, they can work in the office next door because, I've seen it, right, where you've got, the national security establishment wants to keep the sort of the U.S.-led global order. And then there's, people in the U.S. that are realizing, including in the national security establishment, that this U.S.-led global order is no longer good for the U.S. This isn't working for us. Fighting wars for 20 years with no objective and no progress. And, while our own infrastructure is falling down and our own competitiveness is, we're basically providing an umbrella with our military, with our soldiers, with our base infrastructure, with our defense budget for China to do everything they've done in terms of, it was all fine and good when they were providing, small, cheap, widgets for our consumers to buy. They're outfitting the world with 5G. Like, this is no longer, not non-technologically advanced stuff. And so I think there's this competition between these, call it, two Americas. And like I said, even within the Defense Department, even within the national security establishment, there's, there are people on both sides of this aisle, and certainly across the country. But this conflict or this disagreement about, well, we want to maintain the U.S.-led global order because it's good for us, and despite the preponderance of the evidence that it's not working for us anyway, it's not working for any but a very small sliver of U.S. society. And so I think that is really, does this anger the Americans? Yeah, that small sliver of Americans, I think it absolutely does. I think, this other rapidly growing, 2-3 years ago, this side that this deal doesn't work for us was a very, very small sliver, and it's growing rapidly in terms of its viewpoints, or at least they were quiet. But they're getting more vocal, and they're getting much more greater in numbers, and they're realizing, look, great, let's end this U.S.-led global order. We'll bring, we'll pull in our reins. We'll reinvest in infrastructure. We'll reinvest in education. The dollar will weaken, probably pretty notably. But oh, by the way, the world's gonna have to compete with us with the dollar at 60 or 70 or 50 or 60, and that's historically. Once we put our minds to something, we compete pretty well. We just need the ability to compete.
Getting back to your book, I like the Harry Potter reference in your book where it said the wand chooses the wizard and not the other way around, likening the relationship between oil and the dollar, where it was oil that chose the dollar and not the other way around. If oil no longer chooses the dollar, which currency do you think it will likely choose?
I don't think it's going to replace. I think it's going to choose all of them, right? I think you're going to. Let me rephrase. I think it will choose the dollar. I think it will choose the euro in Europe, and I think it will choose the yuan as a regional currency in Asia, and maybe the yen for the Japanese. We'll have to see. But I think that is where this movie is going, where it's no longer going to be oil's priced only in dollars. Commodities are no longer going to be priced only in dollars and settled. They're going to be priced and settled in 3, maybe 4 of the SDR regional currencies, or SDR basket currencies by region. And this has two dynamics. It shifts the power from the U.S., from the Fed, from Washington to the oil exporter, because now they can start evaluating, instead of oil, if I'm Saudi, before I had to basically restrict my production to maximize the dollars I get from my production. Now I want to maximize my production and sell based on what makes the most sense, right? So if I want, U.S. I don't know, servers, okay, I'll price in dollars, and I also need, maybe I want, maybe I want Mercedes Benzes, then I'm going to price in euros, right? So, and then I'm going to want certain things from China. I'll price some of my oil in euros. So you can adjust the currencies in which you price your oil based on the trade realities that you're engaged in, right? And that in turn makes the global currency markets much more balance of payments driven, right? Because right now, you look at the U.S., what do we have to export to the Saudis? It's treasury bonds and weapons, by and large, on a net basis. Boeing aircraft, and so if you start transitioning the system to a more balance of payments centric system, then you're going to start ranking currencies based on balance of payments, which is how currencies traded for basically all of history up until 1971. From pre-71, most of the time, the currency with the best balance of payments and the highest reserves was the strongest currency, and that's how you rated them. And since 1971, it's been the exact opposite. The best currency or the strongest currency has been the currency running the biggest deficits and has the least reserves, being the dollar. And so to answer your question directly, I think what is going to happen is you're going to have multi-currency pricing and settlement of oil, settlement in goods, right? So they'll settle in euro produced goods and in Chinese produced goods and US produced goods, and any net left over in terms of savings will go into gold, some government bonds of each, but I think your new neutral settlement asset, at least for the time being, is gold.
Okay. Apologies to the viewers out there. We had a bit of Skype difficulties, so bear with us as we continue on with audio. Luke, if oil indeed chooses another currency or a multi-currency, would the dollar depreciate significantly, or would war be on the cards, or should we be looking at something else that may come about from it?
Yeah, if you start to see a more multi-currency energy system, you'd see a lot of the things in 2014, and by that I mean you would start to see the dollar rise sharply. You'd start to see interest rates rise. You'd start to see gold rise with the dollar against all other currencies, and then gold against the dollar. And so really, I think you've seen all of these things since 3Q 14. And so ultimately, all of these things will likely continue until a critical tipping point is reached. And that critical tipping point is when the rising dollar, rising rates cause a problem somewhere, and that will ultimately require one of two choices: either the Fed to basically supply the dollar liquidity, basically fund U.S. deficits by growing their balance sheet again, or it'll force the Fed to not, or the Fed can choose to not do so, basically allow the dollar to continue to strengthen. But that is then going to open the window for the rest of the world to make alternative arrangements that will ultimately result in the dollar weakening. And so it's that next crisis, I think, that is really driven by higher rates, higher dollar, that will force that tipping point of a much lower dollar.
Okay. Yeah, rising dollar. We had Brent Johnson, who was on the show a few weeks back, and if I understood him correctly, he believes that the status of the dollar is not under threat at the moment, given that there is no credible alternative waiting in the wings, and direct currency transactions for global trade that bypass the dollar is still tiny when compared to dollar transactions. Do you agree with Brent's views?
The short answer is yes. I think ultimately our big disagreement is on timing, which is to say, I think he thinks this can to come. And I think this started 5 years ago. And so we're much further down the path that he envisions than I think he realizes. And so the point that there is not the infrastructure in place, there's not a replacement currency. All of these are true at the moment. But what I think and what I think he's missing is that what global central banks are doing with gold, what they've done with the yuan oil contract, what the Europeans are doing by looking at bypassing U.S. sanctions on Iran, all of these things can be changed relatively quickly, number one, but more importantly, it's not going to be the rest of the world that drives this change. It's going to be the U.S. And by that, I mean, in response to my last answer, the rising dollar, rising rates will force a crisis somewhere. And then the Fed is going to have to respond. They're either going to monetize U.S. deficits, which will weaken the dollar, or they are going to not monetize U.S. deficits, at which point the rest has the infrastructure set up to say, okay, the dollar's not working for us anymore, and we are now revaluing gold significantly higher to provide the dollar liquidity that we need. And so we are replacing, we are revaluing gold higher in our own reserves, which is something, the EU looked at doing. And so the fact that we've seen global central banks buying gold the way they have relative to treasuries for 5 years suggests a move in this direction, or a preparation for this potential eventuality. And so that, to me, is where I disagree with Brent that, look, this could happen, this could happen any given Sunday. But it requires, and I think this is what the world is waiting for, because he asks rightfully so, if it's, haven't they done it yet? And the answer is because politically it's complicated, and that's putting it mildly. And so you need the U.S. to be the one to indict the system.
Hypothetically, what new monetary system would you personally like to have as a replacement to the dollar standard if you got to choose it?
If I got to choose it, the system would look a lot more like that which was proposed by John Maynard Keynes at Bretton Woods, which was the Bancor system, Bancor, which is you have a basket of major currencies, and then you have imbalances or deficits and surpluses settled in some sort of neutral settlement asset, whether that's gold or whether that's SDRs with gold. There's a number of SDR bonds. There's a number of ways you can manage that. But ultimately, what that would do would rebalance the global economy, where the U.S. would produce more and consume less. It'd be very, very good for the U.S. ultimately, although inflationary in the near term. But it'd be inflationary for wages too. And I don't think anybody in the U.S., when you've got U.S. consumer debt where it is, I don't think anybody would feel too badly about some wage inflation or some devaluation of that debt outstanding relative to wages. And I think that it would require the Chinese to consume more and produce less, or consume more of their own production, shall we say. So that is how I would restructure it, is basically with a neutral settlement asset that would allow a balancing, it would basically start moving the system back towards, something, more of a balanced system that we had from, 45 to 71, when things worked just fine. They worked actually more than fine. You look at the number of crises that happened back then relative to now in the last, in the ensuing 40 years, and it's not even close. The system was very, very stable. And so I think if you get back to a system like that, you're going to have more stability, you're going to have fewer crises, you're going to have more balance. I just think it's a better, and particularly for the U.S., I think you're going to get much more of the U.S.'s economic potential pushing towards production of real assets, whether it's, commodities, manufacturing, intellectual property, sort of all the things that made America dominant. Get back to doing those things rather than having it so singularly focused on foreign wars and and financing.
Given this dollar crisis expectation, how should investors manage their investments? What should they be in, and what should they be out from?
To me, my views on this have they have evolved. They've continued to evolve. I think it is a situation where you need to decide if you want to be right before or you want to be right after, and allocate a pool of assets to sort of, in almost a barbelled approach, pre-event and post-event. Pre-event, this is, and then that requires you to also, importantly, make an estimate for how long the event is going to last.
Right.
And for me, I don't think it's going to last very long. I think it's going to be short and brief, months, not years, and then require a regular, a response that weakens the dollar significantly. And so for me, going into a crisis, I think the only thing you want to own really is cash and dollars. You want to own gold, and you want to probably own some treasury bonds. Like those are the assets that are going to win going into this. On the flip side of that, on the other side of the event, you're going to not want to have cash or dollars. You're not going to want to have treasury bonds. You're going to want to have gold. You're going to want to have emerging market assets, productive assets in the U.S. and globally, whether that be intellectual property, semiconductor fabs, aircraft manufacturers, software company, just any, real assets, real money, productive assets are going to do really well on the other side of this. And so to me, I look at, my own assets as, all right, I want this barbell approach. Gold wins before, gold wins after. So I think there's actually a point of the economic cycle, long cycle, that gold actually, everybody needs to have some gold. But then I think it's a personal choice beyond that of, all right, the cash, in dollars and treasury bonds gonna win before, but those are gonna be the best things before a crisis, and they're gonna be worse things after the crisis. And so you've got to balance those two barbells based on your own personal, belief, situation, etc.
Okay. So this barbell approach. Okay, let's say we know what to do pre-transition. We know what to do post-transition. But during that transition, what's it going to look like, and what should we absolutely have during the transition?
I think it depends on what the actual event is. If this is managed well, it could be very brief, and markets are shut down for 5 days, and when they open back up, the S&P say goes from 2,700 to 2,000 or 1,800, and then markets are closed for 5 days, and they open up in 5 days, and the dollar is no longer at 100, it is at 60, and the S&P is no longer at 1,800, it is at 4,000. To me, the risk during the crisis is almost everybody is assuming it will be linear and that you will be able to trade through it. And not only am I not convinced that will be the case, history strongly suggests that will not be the case. And that's why I think it is so important to understand that there's a real chance that you are facing a choice. You can be right before or after, but not both. And so that's why I think, to me, the barbell approach is so valid. In terms of structuring assets. And so, what could it look like? It could look like a 5-day market holiday. It could look like, the S&P going limit up for 5 straight days, or 10 straight days. I mean, in the 1970s in commodities markets, people forget that this happened where, something happened and, you come in, market opens, it goes limit up with no volume done, you go home, nothing done. You come in the next day, market opens, limit up, no volume done, go home. And so if you were short, you never even had a chance to cover. Like you came in, you watched it go limit up, and you went back home knowing you lost that much more money. And the critical thing in all this time around, as globalized as things are, if the people say, well, the crisis is going to break out in Europe first, and that's entirely possible, in my opinion, very possible. Mm-hmm. The question then is, do you know for sure how the European authorities are going to react? Because if the Europeans say, we're closing the markets for 5 days, guess what's going to happen? All the selling that they wanted to, that investors wanted to do in Europe, they're going to come to the U.S. and sell in the U.S. to lay off the risk there. They're going to whoever closes first is going to force everyone else to close. And Jim Rickards does a really nice job talking about this in his book, The Road to Ruin. He calls it the Ice Nine, where basically once one freezes, they're all going to freeze. And so I think that's what you're looking at in this crisis. And the reason I think that is if you look back over the last 25 years, every ensuing crisis, it's been a little bit worse and a little bit more drastic reaction from regulators and from policymakers. And in 2008, we had a short selling ban in the U.S. You couldn't short sell financials. You had people forcibly closed out of short positions in the fall of '08. And so to me, it sounds extreme now. I think it's a base case that like the markets are going to be nonlinear. And so I think as an investor, it's important to understand that is sort of how these things go down when they go down, when you go through these currency system transitions, and not be so heavily weighted one side or the other, because nobody knows. I certainly don't know, and that's why I advocate this barbell approach. You can be right before, you can be sitting all in cash and treasuries and say, I want to own this, and I think gold's going lower, and I'm going to be in all cash and treasuries until the event, and then I'm going to put it all in. And the reality is very possible that you'll be right, and then they'll shut the markets for 5 days, and they'll reopen, and gold will be at 3,000, not 1,000,
yeah.
And the market and you'll never get a chance to cover. You will have made your donation on a real basis to the U.S. government by the real loss of your purchasing power of equities, inflation, gold. Thank you for your donation, and the game moves on. And that has happened regularly throughout history. It's just been a long time since it's happened in the U.S.
Before we wrap up, can you let us know how we can get a copy of that book, the Mr. X Interviews?
Absolutely, yeah. The Mr. X Interviews Volume 1 is available on Amazon.com in the U.S., U.K., I think in Europe as well. So check that out. It's we've had great feedback, and it was the number one new release in macroeconomics on Amazon for a number of weeks after its release. So it was a very exciting acknowledgement for the book. So yeah, check it out. We've gotten a lot of great feedback about it.
Okay, will do. And can you share with us what Forest for the Trees does and the opportunities your company offers?
Absolutely. So Forest for the Trees, FFTT, we do investment research, unique investment research for sophisticated investors. That's institutions as well as individuals, and have a number of different product offerings. And we aggregate a large amount of disparate data from publicly available sources in a unique manner, trying to identify economic bottlenecks. And the reason we're trying to identify economic bottlenecks in sectors is that it's been our experience that excess returns accrue to those sectors positioned to benefit from or be hurt by developing economic bottlenecks. And so that's really what we're looking to identify as we're filtering through the information that we go through.
Okay, and I believe you're pretty active on Twitter. Would you mind sharing your Twitter handle so we can all follow you?
Of course, yes, thank you. It's at Luke Gromen, LukeGromen, all one word. And yeah, I have a pretty active Twitter feed, and highlight a number of different stories that I think are of interest, etc. throughout the day, most days.
Okay. Luke Gromen, we appreciate you coming on the show and your patience, and we do wish you all the best in future endeavors and with the future volumes of the Mr. X Interviews.
Thank you very much.
That was Luke Gromen, founder of FFTT LLC. For more of his writings on precious metals, please visit his website, fft-llc.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.